Right, I don't know about you guys, but recently in the Discord, I've seen, because some of the channels are popular at different times of the year. We had the SPAC channel that was really popular a couple of years ago, which feels like decades ago now, and I'm sure you've changed the name. But very
it's
recently...
Bagholders Graveyard now.
Bagholders Graveyard, yeah. Very recently, the banking and savings account section has been really, really busy. I've noticed that. I don't know if you guys have noticed that.
Yeah. I've been in it a lot, yeah.
Yeah, so why? Let's talk about why.
I guess the reason why is that the rates are really getting quite exciting. I remember there was a time when we were all really excited for the Chase 1.5% savings account, and now that's pretty far behind. I mean, we're not going to be getting too excited about that. Monzo managed a 1.55%, but that's come back down. I mean, I'm looking at the rates now on 1 year fixes and on 2 year fixes. We're looking at 4.35, 4.71 on a 2 year, 4.86 on a 3 year, and 5.01 on a 5 year fix. Which, even if you think that interest rates are going to go up, do you really think they're going to be above 5% for 5 years? That seems quite unlikely to me. So you may get a couple of years of real joy out of that account. I've jumped the gun a little bit. We have some cash that we were saving for our mortgage. We normally pay it off once a year, but the rates are so low at the moment, paying off something that's accruing interest at 1.29% when I can get a far better rate somewhere else. Our mortgage doesn't expire until 2026, so we've just put that in a nationwide account. It's a 3 year fix, can't touch it, but it's paying 4.75%. Which seems like a far better deal than paying off the mortgage a little bit earlier. Eventually, I'll just pay it off with a little bit of Nationwide's money as well. But just even the notice accounts as well. I'm just looking quickly down the list now. We've got 3% on notices. We've got fixed rate ISAs at 4.35. Lifetime ISAs have jumped up to 2%. I saw there's a nationwide, they're doing like a easy access. They're calling it easy access, but it's called a triple access savings account where you can access from it 3 times a year. So it's probably a good place for your emergency fund. And that's paying, I think it's 2.35%. If you take from it more than 3 times, the whole thing drops to 0.35%. So there's some pretty interesting accounts. I mean, you start to look at your stocks when you're seeing 5%, and that if that's the risk-free rate that we're going to experience, then stocks have to do really well to make it worth taking some risks. Steve, have you seen anything that's caught your eye?
Yeah, I had a look at one which was a slightly unusual one. It's the Barclays Rainy Day Saver, which I think is instant access. You're only allowed to put $5,000 in it, but it pays at about 5.12, and 5% is the kind of thing I'm getting excited by rounding up into my Chase account by trying to spend stuff on my Chase card and get. I think you get 1% cashback still actually at the moment on that, so It's marginally better, and the kind of change goes into the rounded up thing. But yeah, rates are high at the moment. I mean, I'm wondering whether that might be a nice placement. It won't take all of my emergency fund. I'm expecting bigger emergencies than that, but that would be a good thing to have. And I think you need their current account too, which I currently don't have.
And finally, if you are looking in my direction as well, talking about my mortgage, nationwide mortgage right now fixed 2 year was 5%. I think the 3 year was 6%. Oddly enough, the 10-year was 4.8% or something like that, but that's still ridiculous. My 8 years left on my mortgage term right now is fixed at around 2%, so I'm doubling my payments going forward. So in my head, I thought I will be saving a lot of money if I spend my money on my mortgage rather than in stocks right now. And it's this thing about the problem that I've had is, am I interrupting compounding here? Do you think that I'm interrupting on my compounding?
Yes. The question is whether it's a good idea to do that. The issue you have is that your interest is going to compound, and it might compound at a rate that makes it hard for you to pay it down with the money you have, and you want to stop that, and you can then start building back compounding stuff. I mean, that's always been rule one, right? If you have any debt that's running at reasonably, anything remotely high interest rate, I mean, we talk about credit card debt as the obvious example of this, but that's sort of double digits percentage. We're not quite talking that on a mortgage, at least not yet anyway. But yeah, get yourself out of things that are certainly interest carrying debt. Student loans less obviously, but that seems to be the right thing to do to me.
Yeah. Well, Munger, he always says don't interrupt compounding, but he adds the word unnecessarily at the end of it. And if you feel like you're coming to a point where you think you're getting to, you need to interrupt compounding, then that becomes a necessity to do so, doesn't it? So in your case, I think, as much as I like calling you paper hands, it's been probably the joy of my week calling you that. I think in the same position, I would have done, well, I have done a similar thing when 2014 or 2015, we had quite a lot in a stocks and shares ISA. We wanted to pay down our mortgage because we had a dream of going down to 4 days. So we put about 50k on our mortgage, and that came out of some savings, but mostly out of a stocks and shares ISA. I left a little bit of residual behind. And I've started up again from then. I thought wrongly that 2008 to 2015 was quite a long time for us to be pretty much scot-free on compounding. If I'd have left it there, I would have been infinitely better off. But at the end of the day, it's personal finance for a reason, because it's literally about you. And that's how I feel now. I mean, since then we put more money on our mortgage. Our dream is to be mortgage free, and not because that's at 1.29%, that's a particularly sensible idea. I mean, it's the cheapest kind of debt you can get. It's there'll be people listening that are quite envious of that mortgage rate. But the same thing for us is that we want to clear it, because when we clear it, that's our biggest expenditure. Well, it is at the moment. It depends how energy bills go when this cap finishes. But yeah, it's currently our biggest expenditure. And once we get rid of that, we're free to do as we please. So my wife really does want to go down to 4 days a week. I've investigated going down to 4 or 3 days a week as well. And that's probably what we'll do. But yeah, do you have anything to add, Paul?
Well, I was wondering if you guys are feeling it now. Obviously, you've opened up one of your high-interest savings accounts and fixed in for like 3 years or something like that. Are we feeling this risk equity rates dragging money over away from stocks and going into bank accounts now?
I think Steve's feeling it more than I am. He's historically been an owner of gilts, I think, which is something he kind of doesn't particularly admit to anyone else. Bad luck, Steve.
Who would admit that?
Well, it feels like a kind of Buffett and Airlines thing to me. He seems to be getting tempted by them again. So I think he's more tempted by this than I am, although he'll tell you what he thinks in a minute properly. In my case, no, I'm not yet feeling the draw away. I mean, I continue to look for better places and more interesting places to put my emergency fund, for what it's worth. So I am kind of switched on to this sort of thing. But I've always thought that, look, strictly, I know that there's been an easier way to my, probably an easier way anyway, to my kind of personal finance goals. And that's always been to buy an index or an ETF or something like that. It's very hard to outperform those things. Strictly and deep down, I kind of know that I ought to just be banging this into the VWRL or whatever. But I haven't done that. I've tried to pick stocks because I think it's interesting and I'm open to the possibility that I might do better than it. So the thought that I might do better by sticking it into bonds, or I might reach my kind of goals in a fairly boring way by going to bonds, doesn't particularly move me, because I think I probably could have reached it in a more boring way anyway.
So I was going to say, I don't think I'm a million miles away from buying gilts, but then when you look at the rates, I'm probably still about 40% away from buying gilts. And the reason is this. Look, I base my portfolio on returning about 6.5% when I do any of my projections. So I'm trying to be really conservative, because the thing is, I wouldn't buy VUSA, I wouldn't buy an S&P tracker. I know historically that's been the best thing to buy, but it makes no sense in my head that American can continue this ridiculous rate that they've achieved. So I would have bought VWRL, which turns about 6.5%. So the minute I'm starting to get bond rates around that kind of amount, or the minute I'm starting to get a savings account around that kind of rate, I mean, if you're telling me I can get 5.5% in Nationwide or whatever, it's very unlikely that I'd be out chasing stock. But the flip side of that is, I'm not at the moment. I'm still going to put in my full 20,000 allocation into my ISA this year. I've put £6,000 into a GIA, and I've put 20-something thousand into a pension as well. So I've not stopped buying stock. I am buying stocks, but I'm just saying that, at some point, that rate's going to get to a point which is going to turn my head to the point where I say, well, look, this is the most sensible place for my money, because if I can get 6% in a risk-free savings account with Nationwide, or 5.5% in a risk-free savings account with Nationwide, then I'm going to want at least double that from my stocks. To take on the additional risk. So, yeah, that's just where I am at the moment. We've laughed at gilts before. I was buying gilts when they were especially bad, and that's why it's funny. But right now, there's about 4% yield on on a long-dated gilt. That's not bad. That's not bad as a linchpin of your portfolio. If you want something just to sit there, unfortunately, gilts have actually done about as bad as Bitcoin this year. In terms of their actual price. But the yield right now is about 4%. And if you want something that should be a linchpin in your portfolio, hopefully we get some steady government for the next decade or so, that should sit there, tick along, tick up at 1 or 2% a year, return you 4% yield. And that should do pretty well. Gilts, we've smarted at before, but I think they're very quickly being something that we maybe should start considering.